Hey everybody, this is Mitch Ferraro from F Street. I hope everyone's having an amazing day out there today. Super excited to talk about this webinar. I've got my colleague, friend, Brian Gallagher here with me today. We're going to go through some frequently asked questions about the private debt fund, about our equity deals. I'm going to be asking Brian about the equity stuff. He's going to be asking me about the private debt fund stuff. We always love it if you interact with us during these webinar calls. If you have questions or we missed something, please feel free to tap it in the chat. We've got another colleague of ours, Peter, that's behind the scenes here that is monitoring everything. He'll let us know what those questions are. So please feel free to chime in. But again, Brian, I'll let you kind of introduce yourself as well. So go for it, bud.
Yeah, thanks to everybody for joining us today. Yeah, we're excited to tackle some investor FAQs, and the best questions are the ones that we don't know are coming. So toss those questions in the chat at any point during this little roundtable today. And Mitch, what do you say we jump into it?
Yeah, let's get started.
Let's do it.
So awesome. So who are we? So we are F Street. You see in this picture here from, I believe it's left to right, we have Josh Lurie, Scott Lurie, and Nick Young. They're all of our principals. Scott is the owner and founder here at F Street. Scott has coined a term, planting money trees. We plant money trees all the time here at F Street. We're looking to grow generational wealth for people through alternative investments, mainly through real estate. And then we have our team here as well, $619 million of assets under management. You see Brian and I are on there along with more of our team. We actually have a bigger team than this. We're just highlighting some people here.
Yeah, that $619 million in assets under management, that's just on the equity side of the business. So that doesn't include the private debt fund, which we'll dive into more and Mitch will talk all about. But that's just our ground up multifamily, ground up industrial, multifamily acquisitions, industrial acquisitions, and the variety of other more commercial real estate investments that we make here at F Street.
Yeah, absolutely. So, and again, founded in 2009. We do multifamily, industrial, and the private debt fund. The private debt fund is completely separate of the equity side, or what we would call the equity side of the business. So, but we'll dive right into these frequently asked questions. Again, if you have questions or you want something answered, please interact with us. We love it when we get our investors to interact. All right, so the private debt fund, I'll just quickly go through what it is. It is a cash flow flexibility structure. You're going to get cash flow every single month out of this debt fund. It's 10% annual interest. It's very, very simple. A lot of people might use this for a stable return. A lot of people might use this for retirement. You can even compound your interest inside of the fund. So if you're looking to grow wealth quickly, you can add your interest every single month to the actual initial investment to have that compound every single month versus receiving it. Very simple example of how it works. $100,000 investment into the private debt fund would get you $833.33 every single month on the last business day of each month, like clockwork. At the end of the year, you receive a 1099 INT. You are taxed on the interest as ordinary income. The only way to shield yourself from that is if you do get, if you are investing through a self-directed IRA or a solo 401k, that way you do not receive the 1099 because it's a retirement account. And after that 1 year, your money's basically liquid. You can request at any point in time to have your funds come back to you. We do give ourselves a 90-day period to return those funds to you after the 1 year, but typically if you're requesting about $500,000 or less, we're typically getting that back to you instantly. We say about 2 to 3 business days, but typically it is the next business day. So, all right, Brian, I'll let you jump into the questions and I'll answer these as best as I can.
Let's do some questions, Mitch. What do you say?
Absolutely.
So why are borrowers, the people that we are lending money out to through the hard money code, which is the other kind of side of that private debt fund, why are these borrowers agreeing to high interest rate short-term loans? So if you don't know, we are lending this money out at 15%. The borrowers are paying 5 points on the front end. So why are the borrowers doing this? Why are they agreeing to these high interest rate short-term loans?
Yeah, because it's basically, we are a short-term solution, a very fast solution for someone that's trying to get in and out of a property. So basically, they're trying to buy that property, fix it up, get it either sold on the open market right away or get it rented out and refinance. So these borrowers are not only okay with paying this high interest, but they're also know that they're really not going to be able to go to like more of a traditional lender to go and get the funds, not only to buy these types of properties, but also to fix them up. If you go to a traditional lender on these types of assets, and when I say these types of assets, I'm talking distress residential properties. So these properties have basement issues, electrical issues, plumbing issues, hole in the roof. A traditional bank is not going to go ahead and say, you know what, we're going to loan out on something like that. The bank's going to see that as way too risky of a product, and they're not going to give you the funds to purchase the property. And not only are they not going to give you the funds to purchase the property, they're not going to give you funds to fix it up. And that's what we're doing. We're providing funds for the borrower to actually buy the property, and then we're also going to provide the funds for them to fix up the property as well. And when we do that, we actually go ahead and give them a draw for the actual funds to fix up the property. So it's not like they're getting the funds all right away. We do provide them with a small amount up front at closing, and then as work is being completed, they are getting draws from us for that completed work. And we use a really cool piece of technology to make sure that the work is completed and at the actual site of the actual house that we're loaning out on. And then once that work is completed, based off of their scope of work, we provide the draw schedule to them. So flexibility, speed, we have a very good process of giving them the money to pay their contractors once work is completed. And again, what you have to understand is that these borrowers are not taking this is not a long-term loan. Our longest term that we allow is 18 months. They start the first term out at 6 months. They can extend to 12, 15, or 18 months, but that's it. After that, they have to find a new solution if they go past the 18-month mark, or we will work with them if they need a few more months after the 18-month mark, but typically only 18 months.
It's a great answer, Mitch. Let's move on to the next.
Thanks, bud. Appreciate it. Go ahead.
So what happens if a borrower defaults? I mean, they're not following the agreement that they entered on that front end of the loans. What happens if a borrower defaults, and how does that impact investor returns? So the investors that said, hey, I'm going to invest in the private debt fund, I'm going to get my 10% annual interest paid monthly on the last business month of every day, or last business day of every month. So if a borrower defaults on one end of the business, how does that affect the investors earning their 10% on the other side of this business?
Yeah, short answer is that it does not affect the investors getting the 10% annual return. And I'll try to explain this very simply. We absorb the foreclosures. So typically we're foreclosing on about 2 to 3% of our loan portfolio per year. We've got about 500 to 600 active loans out in the marketplace at any given time. What happens is we actually have a whole REO asset management team that takes care of our REOs or of our foreclosure process if we have to do that. Now, we don't want to go into foreclosure. We don't want the borrowers to default on the loan, but if they do, we are able to go through the foreclosure process because we are in first lien position on that specific asset when we loan out the money. So that protects your investment into the fund, because if the borrowers are not meeting the agreement, we do have the right to take the property over through foreclosure. And when we do that, we have a few options. One, we can sell it on the open market right away, like put it on the MLS and sell it as that property is. We can reach out to our investor network that are flipping homes in that area to see if they want that specific property. Or if we have the resources in that area, we'll go out and actually fix the property up ourselves and then resell it on the open market once we go ahead and fix it up. Actually, over the past 6 years as well, we've actually made money year over year through our foreclosures. That does not mean we've never lost money on a deal. We've lost money on a deal before, but year over year as an aggregate, we've made money on our foreclosures. So it's actually become a net profit center for the business. And that's attributed to our underwriting. We also do all of our own underwriting in-house. We take in about 350 to 400 loan applications per month. We loan out to about 30 to 40 of those. So out of the entire applications that come in, we're loaning out to about 10%. So we're picking the best deals that make the most sense for us to loan out on. And again, that's why we're able to have such a good default rate and also have such a good profit from our defaults, is because we're underwriting really good deals.
Another great answer
Am I
from
crushing
Mitch.
it or
You're
what?
crushing it.
All right.
I love the energy. I love the answers. Honestly, I'm wondering why I don't have all my money in the debt fund right now.
Oh, look at that.
So let's
That's
hit
nice.
the next one. What do you say? What is the internal F Street process for making distributions every month?
Yeah.
So we have, hundreds and hundreds of investors into this debt fund,
Yep.
and we really hang our hat and our reputation on that last business day of every single month. We are sending out that distribution
Yep.
to the investors that are distributing and compounding, making sure that it, flows properly and that they can see that increased principal amount if it's compounding month after month. So what's the internal process here to make sure that, we're doing what we say we are going to do?
Yeah, our accounting team here is absolutely amazing. At the end of each month, they're working hard. They are in their screens, making sure that all of the accounts are getting all their monthly interest payments every single month. We do send out notifications every single month that you've received the payments. And I'm telling you, when you wake up in the morning on that last business day and you look at your account and you see that money in there every single month, it's a great feeling. I mean, this at the end of the day is what continues to make our business run. We do what we say what we're going to do. And again, every single month, last business day, you open up that bank account, it is actually there. So you actually get notification via email. You also get notification on your investor portal that shows that you've received the payment, or if you go on your investor portal, you're going to see it compounding onto your actual principal every single month as well. And we make sure, and if at any point in time, if something is like you don't see it in your account or you for some reason it's not there, we are always on top of stuff like that as well. Myself included, where I make sure that every single month our investors are getting their money, and they are, and it's like clockwork. And I know that there are investors on this call that get that every single month, and we do a really good job of making sure that at the end of the day, even maybe a day before, you're getting that money into your bank account. All right, next question.
Last one for the private debt fund. So after the initial hold period of that 1 year, how can I get capital in or out of the private debt fund? So Mitch, you said that after that 1 year, it's essentially liquid. So I just want you to touch on that a little bit further and say, so let's say I invest $100,000 today and it's June 12th, 2026. And I said, Mitch, I need my $100,000 back. What does that process look like?
Yeah, absolutely. So basically you make the request through me. So you reach out to me, and already, if you invested in the private debt fund, you have heard from me, you have talked with me, you have emailed me, you have texted me, we have communicated some way or another. You connect with me, you let me know that you want the money back. I then request that through our accounting team, and then our accounting team processes that payment to get sent back to you. Again, typically we're getting that back to our investors between 1 to 3 business days, but it's a very simple process. You just make the request through me, and I let our accounting team know right away, and then we adjust your position inside your investor portal. Because let's just say, Brian, you invested $100,000 and you say, hey, I only want $50,000 back. Well, then your investor portal is going to reflect your $50,000 position now because you took 50 out. Or if you take it all out, you'll see a 0 position inside your investor portal. What's also really nice, at any point in time, if you invest today and you see us doing a great job, and in 6 months you're like, I want to invest some more money, it is super simple to go into your investor portal and make an additional investment into the private debt fund. We only ask that you do it in $5,000 increments at the minimum of $5,000 after you've made the initial investment of the minimum of $50,000. So very simple to add to the fund, very simple to get it out. And again, to get it out, you would just request it through myself, and we'd get you your money back right away.
And now, Mitch, I'm going to hit you with a curveball. It's not in our slide deck. It's just a total curveball question, private debt fund related.
Here comes the home run.
I know we've talked about this on past ones, but I just want to make sure you have the answer today as well. So we've talked about this war chest, the private debt fund war chest. Okay, so what is the war chest, and why is it critical to not our short-term success, but our long-term success as a company, as the hard money co and the private debt fund as a product for investors to park their money?
Yeah, very great question. And it is a basically like rainy day fund. So what Scott Lurie, our owner and founder, what he does is every single year with the private debt fund, the net profits that come out of the actual F Street private debt fund and the hard money co, he leaves that money on the balance sheet. 50% of it goes to pay taxes. The other 50% stays on the balance sheet. There's $11 million on our balance sheet. So if you were to look at it at our audited financials, you would see a line item that says members equity, $11 million. That's Scott's money that he keeps in the private debt fund as a rainy day. It helps Scott sleep at night knowing that those additional funds are on the balance sheet in case something were to happen. Now, in the 16 plus years that the private debt fund has been around, we've never had a month where we've been in the red. We've always been a profitable company every single month. We've always paid out the 10% annual interest every single month. And he does that just so that he can actually feel good that there's this extra amount of money on the balance sheet, knowing that if we did go in the red one month, he would pull money from that member's equity and put it into the business so the business can continue to operate the same as it would every single month. Now, if something like that did happen, I promise you we would be communicating with you, letting you know that something like that has happened, but it has never happened, and we do have these extra funds on the balance sheet for a rainy day just like that.
I got to get you with some more unscripted questions because you just took that and ran with it. I love it, Mitch.
Hold on. There we go. All right, awesome. All right, now it's my turn. Now we're going to grill Brian here a little bit. Oh yeah, get ready, bud. We're going to grill him a little bit with some of these questions on the equity investment side of the business. So here we go. Actually, I'll kind of let you go through what some of our portfolio looks like, and I'll actually let you go ahead and take the pen there.
Oh,
and
absolutely.
And go ahead.
So this is just a snapshot of our portfolio. This is not everything that we own or have developed. But on the right-hand side of your screen, you're going to see South Point Commerce Park. That is our, kind of the crown jewel of our industrial portfolio. It includes a built-to-suit for a Fortune 50 company. It includes 3 spec industrial buildings, all up in Appleton, Wisconsin. It totals over 825,000 square feet of Class A industrial space that we've built in just the last few years. So we're really proud of what we've been able to do up in the city of Appleton, and there's going to be more projects in the future up there as well. We also have Germantown and Augusta, other spec industrial assets, one in Minnesota, one in Wisconsin. And then on the bottom left of the screen, where you're going to see like Breezewood, CDM Tool, Maysville, and Granger, those are industrial acquisitions that we've made. So industrial acquisitions are going to provide maybe a little bit more upfront cash flow and maybe some refinance and value add, but you don't have to wait for the development process and the lease up process to start getting some of those distributions.
And one thing I want to point out too, just so that we're communicating this well, is that on this side of the bit, this is completely separate of the private debt fund. So the private debt fund and the Hard Money Co. have nothing to do, besides it being a part of S Street, have nothing to do with these equity deals, whether it's multifamily, industrial. They're completely their own, what's called special purpose entities, SPEs. Each individual property is its own SPE, special purpose entity. So we just want to be very clear that there's no commingling of funds of back and forth in any of these special purpose entities. They're all their own separate entity.
Yep, so investing in the equity side of the business, you're not investing in one fund type of approach. You're investing a la carte into different investments that fit your investment priorities and goals for the short, medium, and long term. And then this is our multifamily portfolio. Similar, we have some acquisitions and renovation projects we've done. And then we also have on the left-hand side here, some of the ground up work we've done. So Tannery Falls in Sheboygan, Wisconsin, Green Lake Residences up in Brown Deer. We have a Brown Deer 2 project, the Village 43, which is currently under construction. And then you see a few things from Lakeshore Commons, which includes the 199 unit Coast Apartments, the 28 unit Ivy Townhomes, Summit Phase 1, Summit Phase 2. So a lot going on in the multifamily side of things. We have almost 1,400 units, and I think once some of these projects are complete, that's going to be over 1,400 units, and really no slowing down there from us. So Mitch,
you ready?
Let's
Are you
start
ready
the grill.
for this?
I'm ready.
All right, let's go. Let's see what you
Yeah,
got. Okay.
boom.
All right. Have you ever made a capital call after the initial investment?
That's a great question, and the short answer is no. So on our, let's talk about development projects to start. So when we're underwriting a development project, we get the costs from the construction company, the costs that we owe our architects and engineers. We underwrite our fees, and then the profit and loss. We're doing all this underwriting. We lay out the numbers. Then the next thing we do is we say, how 100% sure are we going to be that these are our costs. And it's never a full 100% sure that these are our costs. What we do is we put a hard cost contingency, we put a soft cost contingency, we put an owner's contingency, we put contingencies and reserves all over the place to make sure that we're, if anything, we're over budgeted. So if you over budget on the front end of some of these investments, what's going to happen is even if you didn't need that in that upfront budget, that's just going to be money that goes back to the investors once you're further down the business line. So over budgeting on the front end of the process for us, especially on the development side of things, is a good, it's just a good practice to have. And with each one of our projects, each one of our acquisitions, each one of our development projects, we're using all of our past experience and prior deals and prior similar deals to fuel all of our underwriting assumptions in the next deal. So each model and each set of assumptions is going to be, we like to think it's going to be 1% better or 2% better than the previous one.
Yeah. And let's also too, like, if you're going ahead and doing all this underwriting this way, this is all attributed to what you're going to actually purchase the property for, right? So if you can get it at this price, and we've built in all of these contingencies to make sure that we don't have to make a capital call. We know that if we do a really good job executing, that this is going to be a really smoking deal for us and our investors.
So we did just get a question, what is a capital call? So that's another great question. So a capital call happens when, the sponsor of a real estate deal might not budget enough up front. So maybe you buy a vacant industrial building and you think I'm only going to need $500,000 in tenant improvement dollars and renovation costs and to pay the listing broker that's going to find you a tenant. You say, I'm only going to need $500,000 to get that tenant in. It costs money to put a tenant into a building. Now, if you budget $500,000, but it costs $700,000, so you're short $200,000 to get that tenant in. And if your bank isn't willing to give you that money, what some sponsors have to do is they have to go back to their equity investors and they say, hey, on a pro rata basis, we need you guys to cough up $10,000, $20,000 to make up for that $200,000 shortfall. So I always like to tell investors that we only like to make one capital call, and that's the initial one that's going to fund your investment. And after that, we want to distribute to you. We don't want to have to ask you for more money because it's not a good practice to have, and it's sign of a distressed deal and underwriting assumptions and a budget that weren't dialed in and didn't have contingencies.
Awesome. Yep. Very good. All right. How do you decide when to sell, refinance, or hold a project?
This is a great question. And this is really the $1 million question because we're making this decision on a day-by-day, week-by-week, month-by-month basis with basically our whole portfolio. Now, there's some assets that we've built and they're cash flowing great, and guess what? We're probably going to hold those assets for a very long time. We have a clear path to pay back the investors fully. We have a tenant on a long-term lease. We have a good basis in the building. Those are what we would call a hold. Just where the cash flow is going to increase year over year. All the investors are happy, we're happy, and everyone's making money off of it. Now, how do we decide when we're going to sell or refinance? Well, this is a day-by-day decision that we make as we execute our business plan. So on a development project, as we're building it, we're saying, are we coming in on, under, or over budget? Are we leasing up on the timeline we thought we were going to? Again, how much do we have in the budget from the lease-up period? Are we achieving the rents we thought we were going to? And all of this goes into an analysis that, as we're completing a construction project, it might be myself, it might be our other development associate, Lane. We're going through, all of the numbers and the budgets and the underwriting with the principals and saying, what is our best path forward? So a lot of times, once we complete a construction project, we're going to look at, we probably don't want to sell it because we invested all the time and resources into building it, but we might just peruse and say, hey, what would it sell for? What is the appraised value of the building, and what are recent sales in the market going for? And then when we're refinancing, we're not looking at one bank or one type of loan product to refinance. If it's a multifamily deal, we will look at HUD execution, so that's housing and urban development. We'll look at agencies, so Fannie Mae and Freddie Mac. We'll look at conventional bank loans. We try to put as many as many feelers out there and get as many term sheets back.
Yep.
And we'll underwrite all of these scenarios,
Yep.
and the numbers are constantly changing. So we're underwriting and underwriting and underwriting
Yep.
and projecting out our cash flows in each scenario and trying to say what is going to set this investment and these investors up for the the highest chance of the best possible success.
Yeah, and I will say this too. I see these guys. We all sit right next to each other on our side of the office, and these guys are running numbers constantly on different deals all the time. Whether it's a deal that we're sending a letter of intent to possibly buy, a deal that we're under construction, a deal that is cash flowing. Continually, they're underwriting these deals to see what is the best position that we can have for the investors and ourselves in whatever type of asset that we have or that we're going to try and go get. So big kudos to these guys because they are in front of spreadsheets all day long trying to figure out how to best have that asset perform for the investors that are inside the actual fund. We did have a quick question about do we have, and I'll let you take this one, do we have investments that utilize 1031 exchanges?
It's a great question. 1031 exchanges are one of the best paths to grow your wealth, to grow your basis in real estate without paying taxes. One thing I've learned since I've started here at F Street is our investors don't like paying taxes. People that put a significant portion of their net worth into commercial real estate, into real estate investments, they don't like paying taxes. And we absolutely accommodate 1031s in almost all types of our real estate syndication.
And 1031 is the simple thing of what a 1031 is when you get net proceeds from a sale of a real estate asset, you're taking those net proceeds and investing it into a like or bigger asset through real estate. So you don't pay taxes on the net proceeds. You're just reinvesting those proceeds into another asset.
So it's a like-kind exchange under the United States tax code. And we've actually done several webinars and videos and podcasts on this. So check out our YouTube channel. I believe, Mitch, you sat down with Nick Young, our Director of Development. But yeah, we've done these 1031 like-kind exchanges. We've done them into development deals, which is a little less common. But we've also done them multiple times into our syndications and acquisition opportunities where you're going to get that immediate cash flow. So a really great opportunity for investors and something that we're always willing to accommodate.
So short answer, we do it. And then like he said, if you just go to YouTube, search F Street Milwaukee, you'll get our page. And I did a podcast with Nick Young, our development director, that specifically talks about what we can do for 1031 exchanges.
And we got another question. Are there any 1031s right now? And also, what is the minimum amount? So we don't have a steadfast cutoff for these 1031s. We have a pretty well-oiled internal process to accommodate these 1031s. It's written into almost all of our operating agreements that we're able to do this. And able to accommodate these investors in these larger syndications.
Yeah, what I'll tell anyone that is interested in a 1031, you can reach. So how we kind of work it is we sit down, we have a conversation, we have better understand because 1031s are a time sensitive vehicle. So you have to identify a property in so many days. You have to close on a property in so many days. So what we typically like to do is we like to have a conversation with you first, better understand what you're doing, when you're going to close, how much the net proceeds are going to be. And then we start tailoring the deals that we're seeing and that we're underwriting to a specific deal that might fit your net proceeds. So we do like, for the 1031 exchanges, we do like it to be $500,000 or more. We would prefer $1 million or more. We do understand that is a large amount, but for it to make sense for us to go into what's going to be called a TIC, a tenant in common, that's the legal term that we're going to, basically legal structure that we're going to set up to do the 1031, it has to be those larger amounts for it to really make sense.
And like Mitch said, they're time sensitive. So the best time to tell us about, hey, I have a 1031 coming up is as soon as possible.
Yesterday.
Maybe even before you sell the property. When you're under contract to sell that property that you own, that's really the best time to start talking with us about, hey, I'm going to have 45 days of identification that starts in 14 days. So like 2 weeks before you sell it. And no, we've also had certain investors come to us with 10 days left in their identification period, and we've also accommodated that. So but obviously that's going to reduce the number of options that you have to put those 1031 funds into. And if you have any other questions with 1031, you can reach me after this. You can, chat with anyone else on our team. We're always happy to talk like-kind exchanges and how you can, continue growing your portfolio using that tool.
You're crushing it, just by the way. Just want
Thank
to say,
you.
yeah,
Thank you.
absolutely. All right. So, what factors give you confidence in the projected IRRs and cash flow?
This is a great question. So, how do we gain confidence in the investments that we're making? So, for example, if it's an industrial acquisition, generally there's a lease in place to occupy either partially or the whole building. And these leases in industrial acquisitions might be anywhere from 2 years to 10 years. So we know that they have to pay rent, every single month. We know that a lot of times, especially in the industrial acquisitions, it's a triple net or even an absolute net lease, which means the tenant, not the landlord, the tenant is going to be responsible for paying insurance, paying taxes, paying operating expenses. And if it's an absolute net lease, it means they're basically responsible for everything, even capital repairs and roof repairs and parking lot repairs. So in an industrial acquisition, that gives us confidence. Is like the lease structure, the tenant that's in there, does the tenant have good credit? Have they been in the building for a long time? Have they invested in their space? Have they put money into the building as the tenant? Are they likely to stay in the building? So that's going to give us confidence in the cash flows. Another thing, if there's vacancy, we spend a lot of time doing market research, talking to brokers that have boots on the ground in that market. For example, we bought a building in Granger, Indiana.
Yep.
We don't live in Granger, Indiana, but there are brokers that do live in that area, in the Elkhart area,
Yep.
and they live and breathe the industrial real estate market in that area. So what we do is, we get on the phone with them and we chat with them and say, hey, what's this market like? What can we expect if the building is vacant? What can we expect for a lease rate coming in? Can you send me lease comps executed in the last 6 to 12 months on, call it 150,000 square foot spaces and up? So a lot of market research goes into it. And it's the same thing with multifamily. With multifamily developments, we're saying, hey, what rents are similar properties achieving? So similar properties that were built, call it in the last 5 years that are, within a mile or two. What amenities are they providing? What unit types are they providing? We get really granular with our rental comp analysis, so we know what our cash flows are going to be. And as I mentioned earlier, we try to have each project and each development fuel all of our assumptions into the next one, so we can make more educated, educated projections. Because at the end of the day, our pro formas and our cash flow models, as much as we like to think that they're really accurate, they still are projections. So it's all about checking the assumptions. As an investor, I think that questioning assumptions in the sponsor is really the best way to vet them. What are your assumptions? It's really easy to really focus on IRR and really focus on equity multiple and cash on cash, and those are extremely important. But questioning their assumptions and how they got to their assumptions is really what's behind those numbers, and is going to give you the best call it clarity into what that sponsor is all about.
Right, and anyone can tell you you're going to get a 30% IRR, and tell you all of these kind of really things that make your eyes get big and that you're going to have a really good return. But what Brian's trying to say is, how are you getting there? What assumptions are you making that allow you to say that you're going to get that targeted IRR? And again, what Brian was saying is everything is a target. We're targeting. We're projecting to get there based off of what we're assuming and underwriting these deals. And I wanted to just point out a couple of other things too on the due diligence side, like on the industrial acquisition side. If this is something that we see during the initial due diligence, we are then down there. We will go to the site and we will spend a day or two with the actual brokers and the owners and really make sure that what is being said and what is being told to us is accurate. And then two, on the multifamily development side, we do something what's called a Tracy Cross market study. Tracy Cross is a well-known market. They basically go out and they look at things like, what's the job situation in that market? What is the population in that market? What is the income in that market? And they give us all these key indicators that help us make a decision if that's a spot that we want to go develop. So my point is that we do a very, very deep dive into due diligence and to make sure that these things are what we're trying to project as our IRRs and our cash flow, there's a lot that goes behind that to make sure that when we present it to the investors, that it is the correct information that we're presenting to you.
Absolutely. All right. Just a few questions left, so let's rip through these.
Hey, what risks should investors be aware of with ground up or value add deals?
Yeah, absolutely. So I'm just going to focus on the ground up here, and I'm just going to rattle off the few risks that are inherent in any deal. There's risk in every single real estate investment. It's really just how much of that type of risk is there. So the first risk is going to be, I'll just call it straight up construction risk. Not very common in Wisconsin, but you could get an earthquake that messes up the construction site as they're pouring concrete. You could have an extra hard winter or an extra rainy spring. Different, forces that are beyond our control can screw up a construction process, or having a general contractor that might be less experienced, which we really try to use best-in-class contractors that are the best in our market, rather than taking a risk with a newer general contractor. So there's a lot of risk just set up in the construction process. Another risk is capital markets risk. So where are interest rates today? Where are they going to be tomorrow? That's always, I feel like we've had a few $1 million questions, but where interest rates are going, that is the $1 million question.
Right.
Is the Fed going to raise rates or cut rates? I always hope they're going to cut rates, but it hasn't really happened this year. But we can't hope on this stuff. So we have to run sensitivity analyses to say, hey, when we finish this construction project that we start today, where are interest rates going to be in 18, 24, 36 months when it comes time to refinance that project? Lease up risk is another. Can you get the building from 0% leased and occupied to 95% leased and occupied? What is the timeline that takes? So that really is fueled by the the market studies and the market analysis that we do. So construction risk, interest rate risk, and lease up risk are three of the ones that I like to focus on, and that you should ask with really any deal that you look at.
Absolutely. All right, what makes your deal flow different from other firms raising capital?
This is a great question. We are an extremely flexible and nimble firm. We can change the types of deals we're looking at on really a moment's notice. We are not tied to do one specific type of investment. When we've always acquired industrial assets, but when we acquired the Granger asset in December of 2024, we realized our investors really kind of ate up the equity, and it wasn't a hard capital raise. We got that capital raise very efficiently, and our investors seemed really excited. So what did we do after that? We started saying, hey, we have to go acquire more industrial assets. So we've acquired, I think, 4 or 5 assets around the country since then, and we have a dozen properties that could be coming to our investors soon. We have 2 that we just got under contract. And so when our investors, they might not verbally tell us, but we can see by their actions and by the way they are investing their money, we can see what deals they want us to bring. I mean, we're really an investor-focused firm, and the investors are the lifeblood of what we do. And we just want to keep giving them the types of deals that they love and that they want to invest in.
Yeah, and I think you bring up the great point of our investors are the lifeline of the business, whether it's on the private debt fund side or if it's on the equity side of the business. And Brian brings up the great example. When we started acquiring industrial buildings in 2024, at the end of 2024, we just saw the demand from our investors. So we shifted and really started focusing on industrial, along with still working on development on the industrial side and on the multifamily side. But we're listening all the time. We're seeing what the investors want. For some investors that might be on this call, you saw how quickly those capital raises were for some of the industrial deals. I had investors call me up and say, hey, Mitch, do you still have room in Granger or in Maysville? And sadly, I had to say no, because they raised so quickly because investors wanted that type of deal. So we're always listening, we're always watching, we're making sure that we're communicating with the investors. I think that's one of the biggest things that we kind of separates ourselves from other firms, is that when you call us, when you email us, when you text us, we are like Johnny on the spot, trying to get back to you as soon as we can because you guys are the reason why we're in business. So we want to make sure that you're having a great experience. We want to make sure that it's seamless. If there are bumps in the road, we're communicating with you. We're letting you know when things are good and we don't hear from you. That's even better, right? So we just want to make sure that we're always listening to our investors because, again, they are the lifeline of the business. All right, how do you build and maintain demand for your lending product? Oh, this is a great one. So this is on the private debt fund side. So what we're seeing right now, and I always like to use Scott's. Scott did a webinar once. I got to watch him, and he pointed out that during good times, like during good economic times, F Street does really well. During volatile times, during times where things are unsure, we do even better. And that's because during those volatile times, people, investors, are looking for opportunity more. And you're able to get opportunity more because things are just, there's fear out in the marketplace. People don't know what the next 3 months are going to be or the next month. So our investors are always looking for those opportunities on the real estate side to buy properties during times that might be uneasy. So as of right, and we're seeing that right now. We're seeing some volatility in the stock market. People don't know what really are going on. In the beginning of the year, we were taking in about 300 loan applications a month, and that's now ticked up to 350 to 400 loan applications a month. And that's a big difference. That's a few extra deals a month that we're getting to be able to continue to lend out to those borrowers that are borrowing money. We also do a lot of marketing. We do a lot of Facebook marketing, Instagram marketing. We work with brokers. We have a great referral program. Our borrowers are a great reference for us because they reference other borrowers that are in those markets to come to us. So there's a lot of different avenues that we do to make sure that we're bringing in those applications. And I know we do a great job of marketing, and we're also one of the easiest to work with. So that is just a few different ways of why we continue to have good success on the lending side.
So we're going to just open this up to an open forum. If you have any questions, toss them in the chat now. Mitch and I are going to stay on for another few minutes. And if you have any questions, like I said, toss them in there. If not, I hope everybody has a great rest of their day and has a great weekend because that is almost here. Thank you.
Yeah, so the question was, what if I'm not interested in receiving the interest payment from the private debt fund? Great question. Simple answer, compound it every month. So instead of getting that monthly distribution into your bank account, have that tack on to the actual principal. So you won't be receiving the money, but on your investor portal, you'll see then, for a simple example, you invested $120,000 into the private debt fund. Month one, you're going to receive $1,000. After that first month, you have now $121,000 in the fund, and you're going to receive 10% annual interest on that money. And that'll just continue to grow every single month. So you don't want to receive the funds. You would just, when you sign up for it or when you go to make your investment, there's what's called an interest election form. You either elect to get paid every month or you elect to compound every month. And you just let us know you're going to get compounded, and we'll make sure that you get compounded every month. So we'll just stay on again for just a couple more minutes here. Again, guys, if anyone needs anything, you can reach the short guy at Mitch@fstreet.com. You can reach the tall guy, Brian@fstreet.com. We're here. Again, we love to communicate with our investors. We try to be very prompt. We try to be very on time. We understand your money is your investment. We understand that it is your wealth. And I always like to give people kudos for coming onto a webinar like this because at the end of the day, it's up to you to grow your wealth. It's up to you to do your due diligence. And we're just here to give you the information and hopefully you invest with us.
We got a question. How frequently should I expect updates on equity deals within F Street? So during the construction and lease up process, we try to do investment updates that get posted to your investor portal quarterly. So every 3 months, sometimes it might even be a little bit more frequent than that, every 2 months. If you ever have any questions, and maybe it's the 2 months since the last update, and you just kind of want to know how it's going, you can reach out to me, Brian at F Street. I can send you, construction photos, lease up progress, all of that. I mean, we're tracking it all the time. And then once the building's complete, or once all the buildings are complete, we will continue updating you on how the refinance is going to go, and expected distributions, and all of that. And then once a property is stabilized, we don't always continue updating quarterly, just because generally you're just getting the quarterly or monthly checks, and we consider it a stabilized property. So once we've kind of completed every part of the business plan except selling the property at the very end of the business plan, those updates might become less frequent. But really, anytime there's material information, we want to tell the investors right away. And if you want to know anything at any time, we're always happy to jump on a call, answer an email, really as fast as we can.
Yeah, and I also just want to point out real quick for any investors that are on the call, if you are local, even if you are out of state or across the country from us, we're located in Milwaukee, Wisconsin. Our door is always open. We love it when investors come to visit us. If you are invested in a deal that's local to us, we will go to the project. We will go to lunch. We will go to dinner. We will, our goal is to build a very long-term relationship with all of our investors. So if you want to maybe get boots on the ground for a potential investment, or an investment that you're in, or you just want to get to know us better, just let us know. We will absolutely set up some time for you to come in. We'll make sure you have a great time, build the relationship, because at the end of the day, that's what we want.